Hello everyone, I am Dr. Vasan Boroste from Department of Commerce, KTHM College Nasik. Today I am going to discuss with you the Accounting Standard 14, which is in the first chapter. First of all, I would like to recap. In the earlier video, we have already seen the introduction of Accounting Standard topic and its applicability. In the previous few lectures, we have discussed about Accounting Standard 5, that is net profit or loss for the prior period items, changes in accounting policies. After that, we have already seen the accounting standard 10, that is property, plant and equipment. We have also seen the practical example of AS10. So in this video, we are going to discuss about accounting standard 14. The name of accounting standard 14 is accounting for amalgamations. Let us start accounting standard number 14. What is that? First of all, AS14 is accounting for amalgamation. As you know, amalgamations means at least there are two companies come together for a particular purpose. In this video, we are going to see first of all the applicability of AS14. So first of all, accounting standard 14 deals with accounting for amalgamations. And what is amalgamation? I will discuss later on the definition and concept of amalgamation. It is issued by ICAI, that is Institute of Chartered Accountants of India. As you know, each and every accounting standard is issued by ICAI. It is applicable to all types of enterprises. Then the standard should be applied accounting for amalgamation. So these are the applicability of accounting standard 14, where accounting for amalgamation deals with accounting for amalgamations and treatment of any resultant goodwill or reserve. What is goodwill or reserve? We will see later on how we can calculate the goodwill and reserve in case of accounting standard 14 and its applicability regarding accounting for amalgamations. So here accounting for amalgamation does not deals with. So first of all, we have to consider accounting standard 14 deals with and does not deals with. In the last slide, we have seen here the applicability of AS14 and where it deals. Because you can see here that it deals with accounting for amalgamations and the treatment of any resultant goodwill or reserve. In this slide, we are going to discuss about accounting for amalgamation does not deals with, that is AS14 does not deals with. So we have to see what is that items in which AS14 does not deals. See, Section 230, 231, 32, 33 and 234 of the Companies Act 2013 deals with amalgamation. So these are the sections which are deals with amalgamation. With the cases of acquisition which arises when there is a purchase by one company, refer to the acquiring company of the whole or part of the shares or the whole or part of the assets of any company. Refer to the acquired company in consideration for payment in cash or by issue of shares or other securities in the acquiring company or partly when in one form or partly in another. So the distinguished features of an acquisition is that the acquired company is not dissolved and its separate entity constitute to exist. So these are the some things where S14 does not deals with. So now we have see what is amalgamation. Two or more companies come together to form a new company. Say for example, A company is there and B company is there. So when A and B companies come together and getting form a new company, that is AB company or C company, whatever it may be. So it will be the it will be called as amalgamation. So first of all, what is amalgamation? Amalgamation includes, say for example, here existing company P Limited and Q Limited are there. Both are wind up and new company R Limited is formed to take over the business of P Limited and Q Limited. So in this case, you can see P Limited is there and Q Limited is there. So P and Q are going to wind up and new company called as R Limited is going to be formed. So it is called as amalgamation where two companies shut down and new companies form. So this is called as amalgamation. Then absorption. So what is absorption? Absorption is an existing company P Limited takes over the business of R Limited, which is wind up. Say for example, there is a company R Limited which are going to be shut down or wind up. At that time, suppose P company is going to acquire that company, that is called as absorption. So existing P companies, P Limited is going to take over or absorb the business of R Limited. So it is called as absorption. And external reconstruction. In that case, we have to consider about calculate and consider about accounting standard 14, that is accounting for amalgamation. So what is external reconstruction? A new company R Limited is formed to take over the business of an existing company P Limited, which is wind up. So basically there is a difference between absorption and external reconstruction is what? In the absorption, an existing company P Limited is going to take over the business which are going to be wind up. So the business of R Limited is going to wind up and P Limited are going to take over that business. So P Limited is existing company. Most important, it is existing company. However, in case of external reconstruction, a new company is formed. Here, existing company is going to take over the another company's business. However, in external reconstruction, new company R Limited is formed. Specially, it is formed to take over the business of an existing company, that is P Limited. So, which is going to be wind up. So, wind up is the same conditions. Here, R is going to be wind up. Here, P is going to be wind up. But here, new company is formed. Here, existing company is already there. So, this is nothing but the amalgamation, absorption and external reconstruction. So amalgamation. Amalgamation means what? As I earlier mentioned that amalgamation, the definition of amalgamation or amalgamation means an amalgamation as per the provision of Companies Act 2013 or any other law applicable to the company is what? Transfer company. That is, transferor company means a company which is amalgamated into another company, and another is transferee company means the company into which a transferor company is amalgamated. As I earlier mentioned that the amalgamation or AS14 deals with accounting for amalgamation, where there is a three kind of amalgamation. First one is amalgamation purely, two companies close and one company is formed. Secondly, absorption, existing company take over the business of another company which is going to wind up, and external reconstruction where new company is formed which are going to be take over the business of a company which is going to be wind up. So these are three cases of amalgamation where transferor company is there and transferee company is there. So here you can see the example of amalgamation. Suppose there is a P Limited and Q Limited. Both the companies are existing company. Okay. Now here transferor companies are, these are two companies are transferor company, that is P Limited and Q Limited, and these two companies are going to be amalgamate and form a new company called as R Limited. So R Limited is a new company and this company is called as transferee company. So this is called as an amalgamation of companies. See here types of amalgamation. First one is amalgamation in the nature of merger. Second one is amalgamation in the nature of purchase. Third one is pooling interest method, and fourth one is purchase method. So these are the types of amalgamations. Let us see the amalgamation in the nature of. So we have to see in what types or what is the nature of amalgamation. Amalgamation in the nature of merger, and second one is purchase. So merger is what? There are five conditions to test, that is pooling interest method, and in the case of purchase, when any one or more of the five conditions are not satisfied, at that time it is called as purchase, and when pooling interest method, that is five condition test, are satisfied, at that time it is called as merger. So what is merger? All assets and liabilities of the transferor company become after amalgamation, and the assets and liability of transferee company. Second one is the shareholder holding not less than 90% of the face value of in equity shares of the transferor company becomes equity shareholders of the transferee company. Third one is consideration to equity shareholders of the transferor company is discharged by the transferee company wholly by the issue of equity shares, except that cash may be paid in respect of any fractional share. So these are three conditions. And fourth one is intention of the transferee company is to continue the business of transferor company. And fifth one is transferred assets and liabilities are recorded in the books of transferee company at book values of the transferor company except to ensure uniform accounting policies. So these are the conditions which we have to consider in case of merger. So that is pooling interest method. 5 conditions are there. If these 5 conditions are not satisfied, at that time we can call it as a purchase in the nature of amalgamation, when any one or more of the 5 conditions are not satisfied. So these are 5 conditions. All the assets and liabilities of the transferor company. As I earlier mentioned, transferor company is what? P and Q Limited was transferor company, and transferee company means new company which is going to be acquire the business of old two companies. So shareholders holding not less than 90% of the face value of equity shareholder of the transferor company becomes equity shareholder of transferee company. It is the same case. So the shareholder becomes the shareholder of transferee company. Say for example, P and Q was there. Both the companies are going to liquidate or wind up, and new company is going to be formed, R Limited. So in that time, in that case, the shareholders of P Limited and Q Limited are now become a shareholders of R Limited. So that is the holding. So consideration to equity shareholders of the transferor company is discharged by the transferee company wholly by the issue of equity shares. So most important part is that the shareholders must be uh, the shareholders must be what we can say here, discharged by the transferee company wholly, not partly, by the issue of equity share, except the cash may be paid in respect of a fractional shares. Intention of transferee companies to continue the business of the transferor company. Most important thing is that the intention should be clear while in case of amalgamation, or when we are going to adopt S14, that is accounting for amalgamation. The intention should be clear that the business is to be continued in future. So it should be clear. Transferred assets and liabilities are recorded in the books of transferee company at the book value of the transferor company except to ensure uniform accounting policies. As I earlier mentioned that the business of existing companies are going to be taken over by a new company. At that time, whatever assets and liabilities are comes together of the old 2, 3, 4 companies, and now we are going to form a new company, that is transferee company. In that case, the transferee company must show the assets at their book value of the transferor company. Say we for example, A and B is there, or we can see our earlier example, old example, that is P and Q. So P and Qs are going to be wind up. At that time, P and Qs assets are going to be mixed up, or are going to be collectively recorded by R Limited. At that time, the R Limited should mention the assets and liabilities in the books of their accounting, that is transferee company. R Limited is transferee company. So transferee company R Limited have to mention the assets and liabilities at their book value, except if there is any kind of conditions at that time that should be fulfilled. So here you can see the accounting of statutory reserve. What is statutory reserve? As you know, statutory reserve are those reserve which are created as per the particular statute. When any kind of reserve or statute are there, at that time the company have to maintain that statutory reserve. As per as 14, that is accounting for amalgamation, to fulfill the requirement of maintenance of statutory reserve, the transferee company shall record these statutory reserves in its books by debiting to amalgamation adjustment account and crediting to the statutory reserve account. So this is the most important part of AS14, that is when there is any kind of requirement of statutory reserve, the transferee company, that is new company, so it has to be maintained, or it has to be mentioned the entry, that is debited to the accounting adjustment of amalgamation and crediting to the reserve, that statutory reserve. So amalgamation adjustment account shall be disclosed in the balance sheet under the head miscellaneous expenditure, and the statutory reserve under the reserve head reserve and surplus. As you know, as per the Company Act 2013, companies have to maintain their balance sheets and profit and loss account as per their statutory form. So where the amalgamated after amalgamation adjustment account shall be disclosed in the new balance sheet of transferee company, that is new company, under the head miscellaneous expenditure, as well as in the reserve Head reserve and surplus, they have to mention the reserve, statutory reserve. Now, when there is no requirement of statutory reserve, the entry has to be passed. That is, statutory reserve account debit, statutory reserve account debit. When there is no requirement of statutory reserve, the entry has to be passed as statutory reserve account debit to amalgamation adjustment account. So this entry has to be passed when there is no requirement of statutory reserve. If there is requirement, then we have to mention it under the miscellaneous expenditure as well as under the reserve and surplus. Accounting for goodwill arising on amalgamation. As you know, goodwill is an intangible asset and it has to be treated as per accounting standard 26, that is intangible assets. So, if in case of amalgamation, old companies are going to be amalgamate and forming new company, at that time there may be a goodwill or reserve. If there is a reserve, as I earlier mentioned, that reserve should be mentioned under the head miscellaneous expenditure as well as on the liability side reserve and surplus. So, if there is goodwill, at that time it has to be recorded as per accounting standards 26, that is intangible assets. So, this is the accounting standard 14, accounting for amalgamation. In the next video, I will discuss about the practical example of amalgamation of partnership of amalgamation of companies, where we have to be discuss about how to calculate the purchase consideration and so on. Thank you very much.